Today, Amazon operates a global network that spans nearly every layer of modern commerce, from e-commerce and cloud computing to the logistical pipelines that move millions of packages a day. Their physical presence is everywhere. Look at the data from their first 20 years. The top revenue line climbs incredibly, while the bottom line, net income, stays almost completely flat. Zooming in reveals how thin the margin was. For 2 decades, they hovered at break-even, frequently dipping into the red. This raises a question. Why would the fastest-growing business on the planet spend 20 years operating with almost nothing to show for it? Those lean years were a deliberate, high-stakes gamble. Amazon was willing to forego earnings today to build a market position that would eventually be impossible to challenge. In its early era, the company operated under one primary directive: grow first, address profitability later. They funneled every dollar of revenue back into the system as fast as it came in, treating incoming cash as fuel for expansion rather than as a pool of profit. That expansion required a massive physical footprint. They poured billions into a global network of colossal fulfillment centers, building the infrastructure necessary to move physical goods at an unprecedented volume. This spending was designed to outpace the rest of the industry. The goal was to build an ecosystem so fast and heavily integrated that no other retailer could realistically compete. The sheer scale of these warehouses and delivery pipelines established a massive defensive moat. Challenging Amazon required matching a logistical empire that had already taken decades to finance. But the model faced a persistent economic reality. Moving physical goods is a low-margin business. Even with massive volume, selling retail items leaves very little cash left over after the costs are settled. Eventually, decades of expansion without a return leads to mounting pressure from investors who require a financial yield on their capital. Amazon successfully became the default platform for online shopping, but their massive retail operation was reaching a point where low margins were no longer sustainable. The solution to that economic pressure came from an unexpected source: the launch of Amazon Web Services, or AWS. Cloud computing operates on a different set of economics than e-commerce. It scales through software and servers rather than delivery vans and warehouses, making it far less capital-intensive to maintain once it's established. In the financial breakdown, retail generates massive revenue but very little profit. AWS brings in less total revenue but yields a disproportionately high profit. Acting as an internal subsidy, the cash generated by the cloud business fills the holes left by expensive, low-margin retail. AWS provided the financial foundation that allowed Amazon to continue its pursuit of retail scale without running out of money. Amazon balanced these priorities by running a two-engine system, allowing them to manage growth and earnings at the same time. The scaling side of the business provides market dominance and network effects, making it harder for competitors to enter the space. The profitability side provides financial stability and ensures the long-term support of the people who fund the company. Attempting to grow a company without a clear eventual path to earning more than you spend creates an unstable business model. However, focusing strictly on profit while staying small limits a company's ability to change how an industry works. Aggressive scaling only works if a long-term profit engine is already in place to support the expansion. So when a company says they are focusing entirely on growth, look for where the actual earnings will eventually come from. Because growth alone is not a strategy.